Welcome everybody to this webinar on the new Brazilian rules. We've called it how to manage transfer pricing risks, but surely we should have also said opportunities as well. So we think that we are very kind of lucky today to have Romero Tavares from Brazil. He's a tax partner from Sao Paulo and the ITS leader in Brazil with us to tell us all about how we got here with the new Brazilian rules that are just the signature from the president from being enacted. And we would like just to spend maybe around 30 minutes on those rules, and then of course I'll ask any one of you who have questions to the new Brazilian rules to please use the chat possibility, and we'll try to read as we go along. We would like this to be a conversation as much as possible, so please ask any questions you might have. Before we get there, I'll also present Evaldes, who's a tax manager with PwC Denmark. He will, in the end of the presentation, show a risk assessment tool that we have developed in order to kind of stay ready with the compliance risk. So basically, it's a tool that will help you guide you where to produce your TP documentation around the world, but it could also be used for an APA strategy. So where do you want to have coverage on APAs, for example? But that we'll cover in the end. Before we get to any of that, my name is Troels Nielsen. I'm a transfer pricing partner in PwC Denmark. I'm currently in Lisbon, in sunny Lisbon, where PwC Lisbon or PwC Portugal has been great enough to borrow me a room here. I will start out by saying that just to give you a little bit of a current status on the risk picture in Denmark. I think probably most of you would know that we are now going into the second year of our mandatory submission requirements in Denmark on TP documentation. So the deadline will be 4th of September. So that's something for you to take into, you basically put in your calendar. I think that the Danish tax authority has been pretty clear that they will not be as pragmatic this year as they were last year. We managed to get a number of our clients off the hook in terms of penalties, clients that had missed the deadline for various reasons. But I'm pretty sure that it's correct that next year there will be no mercy, basically. So please make sure that you are staying tuned on the deadlines. What we have also discovered is that the Danish tax authority has actually become quite tough on even if there is one transaction that is missing a comparability analysis. We have clients that have had 4 or 5 transactions documented fully as required, but then maybe have skipped a little bit too easy on the financial transactions. So the loans basically just stating that they think they had a cup on the interest rate. That case has been sent for penalty evaluation. So basically, we see that as a pretty aggressive move by the Danish tax authority. Following the Tetra Pak Supreme Court decision, it's now clear that if we are missing a comparability analysis, that is something that is where the Danish tax authority believes that they can issue a penalty. Another thing we have discovered now, basically there was a little bit of an uneven pattern, I would say, from the Danish tax authority on the penalties. We managed to get a number of our clients off the hook, but some actually did get penalties or at least were sent for penalty evaluation. Yesterday, I received the first formal notice from, so basically an administrative fine for a client that basically they could accept that fine, then the case would be over, or they could deny to pay the fine, and then basically the case would run it through police and the courts like we were used to when we had the pilot cases. So now we are seeing the penalties. They are given administratively, and it is the 125,000 Danish kroner that they issue if a satisfactory TP documentation is sent in afterwards. So that's a little bit on the risk picture in Denmark. Another very interesting topic that we have before us is we have a hearing on the valuation guidance in Denmark. it will now become a formal part of the legal guidance. So it has been rewritten. So that's the 2010 valuation guidance that you probably, most of you know. There are a certain number of changes in the guidance now. And as I said, it's in a public hearing, so we are giving comments to it. But I'm pretty sure, also having had a dialogue with the Danish tax authority and meetings with them on it, that they are standing firm on the issues where they're tightening up. And the two issues that I want to mention here is basically is the routine carve-out, and it's the TAP, basically the tax amortization benefit. So they are tightening both areas. On the routine carve-out, basically, if you imagine you have a Danish IP, have Danish assets, you're moving them to the US, for example. Typically, we have been able to get through with basically carving out the routine profit that stays in Denmark. So if the Danish entity is converted into a cost plus entity or an LRD, of course, we think it makes a ton of sense to carve out that cash flow, because if you tax the whole thing without carving out the cash flow, then essentially you're double taxing, because the LRD and the service provider will stay in Denmark even after having done the restructuring and movement of IP to the US, for example. So we don't think it makes a lot of sense, but the Danish tax authority have been scared a little bit by a number of examples where maybe advisors, clients have been a little bit too aggressive on the carve out, adjusting lower WACs and so forth, so that the routine activity becomes very, very big in the greater scheme of things. So the valuation of that carve out basically leaves very little room for then the exit taxation on the IP. So it's a very strict, I think too strict guidance that will now come into the juridisk vejledning, into the legal guidance on the routine carve-out. Basically, you can assume in the future that the Danish tax authority's starting point will be that you can carve out tangible assets, because in their view, there is nothing called a routine intangible. So basically, the remuneration for the routine activities, so the cost plus and the LRD returns, that is only a return for the tangible assets. And once you've carved that out, there shouldn't be anything left, basically. So that's that on the routine carve out. What is probably even worse is the TAP, where Denmark now effectively will be saying it's a full gross up. So basically taking a consistent view on the seller perspective. So again, let's say Denmark is selling IP to the US. Here in history, basically the Danish tax authority has been a bit conservative in their own view by taking, you could say, the buyer perspective on the TAP, so the tax amortization benefit. So basically using an iterative TAP, which of course is the net present value, for example, over 15 years of depreciation or 7 years. Now they will do a full gross up. So basically they will say, okay, what is the taxation that the seller is facing once they sell the assets to the US? And that's basically 22% times the value of the asset. So that's the perspective that we will have to fight, basically, in the future. So very important changes, and that's also why I wanted to make that known today, that this is what is coming your way. I think that's basically it on the Danish risk picture. So without further ado, I'll basically pass it over to Romero to tell us about the new Brazilian TP rules, which are essentially applying the arm's length principle for the first time since 1997, where Brazil had enacted their own rules, which was fixed margin rules that was not aligned with the arm's length principle. So please, I'll hand it over to you, Romero, and then I'll keep quiet for a while.
Thank you very much, Troels. Thanks, everyone. It's a pleasure to be here with you today, and especially to talk about this topic, because there was a lot of expectation as to whether or not this would become real. That there has been a lot of work done, very visible work done with the support of the OECD over the last few years. And I think, Troels, to answer your question as to why we're here now, and why did it take so long? And then perhaps all of a sudden it seems like it sped up. It is true. So basically, we did not waste a good crisis in the 2015-16 timeframe. Brazil basically at that point in time, with an institutional crisis, impeachment, etc., Brazil asked to accede to the OECD in 2017. This was a tectonic movement from a Brazilian point of view, because especially from the viewpoint of the tax administration, there was a lot of suspicion, a lot of lack of confidence in how good the international tax system was, and perhaps even still is. Brazil felt that it was a fortress. The Brazilian tax authority felt like it was building a fortress, so high withholding tax on everything, fixed margins on transfer profits, so viewing itself as a capital importing country with high duty barriers and high tax against base erosion and profit shifting. It's a very skewed vision and a very mistaken policy, but that's the way that Brazil basically designed in international tax rules for the longest time, with this bias against, if you will, facilitating capital inflow and facilitating trade. It's a shame. But the point is that with the 2017 request from Brazil to the OECD, the first answer Brazil got from the OECD was, of course, the OECD had already been close to Brazil for many years. The BEPS 1.0 project itself had Brazil heavily engaged and participating very actively in all of the actions. But then again, for that process to begin, the first topic to be cleared was transfer pricing. So it was evidently for all of us, it was the obvious response. And immediately a task force was put together with the funding of the United Kingdom, by the way, Foreign and Commonwealth Office. But again, putting together a lot of different tax administrations to help Brazil, along with the OECD Secretariat, understand how the transfer pricing guidelines operate, how the arm's length principle really works, and how Brazil could perhaps see that it would be in Brazil's interest, not only from the viewpoint of facilitating trade and investment, but also from a treasury and from a collections point of view, that it could be on Brazil's interests. And this is a project that started right around then, 2017-18, very intense in those first 2 years, with a lot of participation from a lot of us. I was fortunate enough to be part of that process. But in that process, the Brazilian authority ended up figuring out that while the system was very punitive towards inbound multinationals and inbound investments, it was actually very favorable towards outbound Brazilian multinationals and exporters. If it was by design in the 1990s or not, if it was a replacement to an old export subsidy regime we had, which was deemed illegal by the WTO, that's a speculation that I have. But the point is that the administration was not operating with that knowledge, was basically operating with the knowledge that the rules would be protective of Brazil. And it was shocking to them to see, with the exchange of information, with the help of the OECD Secretariat, the many instances in which there would be, especially Brazilian exporters and especially Brazilian headquartered multinationals, benefiting from the system and basically exporting out of Brazil, for instance, at cost plus, fairly low margin, with residual profits landing in Europe or in some other jurisdiction, and not being deemed taxable in Europe or that other jurisdiction under the arm's length standard, because the profits would belong to Brazil. So there was a lot of structures like that, transfer pricing based structures like that, done by Brazilian multinationals and Brazilian exporters, where effectively you had institutionalized BEPS helping out those firms. And on the other hand, double tax, either effective double tax or the risk of double tax on inbound multinationals. So the OECD process made that let's say the consultation process and the collaboration project made this very transparent, to the point where 2 years into the project in 2019, the Brazilian authority was absolutely convinced, and it was no longer talking about a convergence of rules and perhaps approximating the guidelines to the Brazilian methods and vice versa, but instead it became all about alignment with the guidelines and being on the same mode as everyone else in respect to perhaps enhancing the guidelines going forward, where Brazil would see that they would need but again, through cooperation. But with the prior government, the marching orders were clear and the tax administration was convinced. And this is why between if it wasn't for the pandemic, we probably would have been here 2 years ago. But with the pandemic in between there, in 2020-21, of course, transfer pricing took the back seat. There were a ton of other measures, even within the tax administration, that took priority. But as soon as the workflow started to normalize, even within the tax administration, this project jump started again. It was very quick between 21 and 22, to the point where last year there was rounds and rounds of public consultations on how the law would be drafted, how it would be designed. And again, with Brazil's tradition of high litigation, there was a lot of concern as to whether the law could be very brief, something along the statement of Article 9, simply a pronouncement on the principle, and whether we could leave it all for regulations or simply make reference to the guidelines. And the answer that was deemed both constitutional, legal, and safe enough for the tax administration was to over-legislate to a certain extent. So they came up with this very long draft, which is now again voted and approved in the Brazilian Senate, which basically covers the bulk of the content of the guidelines as they currently stand, 2017 and 2022 inclusive, and making reference to the entire toolkit of what's there and what might be common practices within OECD member countries. So the process, as it went through Congress, it had the official explanation, the motivation of both facilitating Brazil's accession to the OECD and enhancing the business environment in Brazil to attract foreign direct investment, while also at the same time protecting the Brazilian treasury in situations where double non-taxation has been taking place. So the two justifications really caught on, and therefore the law became, to use a North American term, it became bipartisan or all partisan. So the entire political spectrum became supportive of the rule because it had these two features, and that's why it ended up fast tracking through Congress to the point where it was overwhelmingly approved in the lower house and unanimously approved in the Senate. So the way it stands now, as Trolls has mentioned, is basically just waiting for the presidential signature and sanction. Should happen anytime now as Lula returns from Hiroshima from the G7. And as soon as that's done, of course, there will be a wave of regulations that we're very interested in collaborating and curious to see that they will stick to the arm's length standard. But there will be a wave of regulations yet this year. Because the new system becomes mandatory in 2024 for all taxpayers, but there's a possibility of early election in 2023. Right now is scheduled for September, when taxpayers can opt into the new rules, the OECD compliant rules, effective January 1st, 2023. So because of that, the authority is on a very tight schedule. They're chasing this now that the law was effectively approved for the regulations to be put out. So as to how we got here, Trolls, this is basically it. If you want, we can go into a bit of the substance of the rules now.
Yeah, I think thanks a lot, Romero, for that background. I think that would be nice to hear a little bit about, what are the important features of the rules, because I know that there is a pretty broad control, you could say, regulation. So the control parties is a broad notion, and there's also a few kind of important points in the regulation or in the law that maybe is worth mentioning. So please go ahead.
Absolutely, Trolls. The way that when we first saw the test, the way we reacted to it was that it had everything in it, the good, the bad, and the ugly. And at least through Congress, we managed to see the ugly being stricken out. And I'll mention what that was. But there are a few things in there that are still a bit worrying, that perhaps can be ameliorated or fixed in the regs. But the way the law is structured has a lot of good. Basically, it starts with let's say the statement on the arm's length principle. It's almost a replica, a variation of the language of Article 9, basically enshrined in the beginning of the law and stated as a principle which is recurrently referenced in further articles of the law. So systemically speaking, the law is well built. It's clear that that principle should guide the interpretation of all of the subsequent articles of the rule and, of course, of all of the regs. This is the best part about the new law. And, of course, the legislative history and the explanation of motives clearly links that with the OECD view over what that principle means. So this will be, of course, also a very helpful auxiliary method of interpretation, even under Brazilian law, despite Brazil not yet being a member of the OECD. So that's the best part of it. Following that, you also have something which is very well done, very well crafted, which is, again, it has the fingerprints of the OECD staff in it, which is pretty much model rules for how you could state the delineation of transactions, comparability analysis, and methods. So basically the same language, the same content you see in the guidelines is almost word for word in some sections reproduced in the subsequent articles after the arm's length principle is stated as a principle guiding the law. So in the delineation of the transaction, we have all of the different standards, all of the different methods going from facts and circumstances specific to the case to macroeconomics. So everything that's in the guidelines referencing how the delineation of the transaction should take place is also referenced in the Brazilian law. Coupled with that, you also see, of course, some very positive language on the tested party and the ability for Brazil to, again, apply the same standard of being able to test the party that has most reliable information or that is least complex. And in that respect, you can end up using the Brazil party or the foreign party as adequate as you would expect to see in any other OECD member country, which is also very good given where we came from, which was, again, a bias against using non-Brazilian documentation. So in this sense, we can use either or, whichever is the right party to be tested. Secondly, data also. As we put together the comparability analysis, it's clearly stated that data can be used that is both domestic and foreign. So we can effectively use that, provided, of course, we go through the comparability adjustments as necessary to adhere to the arm's length principle. So the language is very well crafted in that respect. Of course, we have a ton of concerns. We're going to cover that as we foresee what might happen in practice and with the regs that will be coming out, given the scarcity of domestic data on the private side, on the taxpayer side, the complexity that some of the comparability adjustments may need to have for us to be able to bring data from outside of Brazil into Brazil, given that Brazil is a large economy, it's a closed economy, prices might be distorted from sector to sector. So the analysis will not be trivial, but the point is that the toolkit is there. The way that the law is designed provides the tools with which we can work to either use domestic data if domestic data is available, or foreign data if foreign data is available and is reliable and if you can properly adjust. Another good tool in the toolbox is, of course, the fact that the law states that to the extent that the data is reliable enough, we can use the full range of comparables. So this is clearly stated in the law. As it is clearly stated that in the absence of a study, or if the tax authorities disregard a study and impose an assessment, they use the median. So they're not going to go for the highest possible assessment either. So I'm going to comment on the fact that we lack alternative dispute resolution mechanisms, settlement, and so forth, where you could end up negotiating something like that. But the fact that the law already clearly states that the authority cannot go for the higher value, they can, they must stick to the median if they assess, and that the taxpayer can use the full range if the data is reliable, is a really positive feature of this new rule. As we move from that, which is, again, the basic tools in the toolbox, right? Delineation of transaction, the old functional analysis, comparability, tested parties, comparables, comparability adjustments, all that is very well done. When we move into adjustments, this is where it had some bad and it had some ugly. The adjustments basically are only upwards, and this is clearly not at arm's length. So this is really not in compliance with the arm's length principle as stated. And the reason for the primary adjustments or the voluntary adjustment, spontaneous adjustment done by the taxpayer to be one unidirectional only is understood and is explained, and it's also supported by the technical staff at the OECD, which is, again, avoidance of non-inclusion at the other side. So if I have a downward adjustment, which is unilateral in Brazil, and I don't have a corresponding adjustment upwards on the other side, I could have double non-taxation. So the authority initially limited, for the primary adjustment, those only for upwards adjustments, which is understandable, again, even if it's not completely in accordance with the standard. More of an anti-abuse rule than the arm's length principle itself. But as we move on to the corresponding adjustments, Brazil does have one, and a corresponding adjustment can be downwards if done through MAP, and Brazil does not have a good track record on MAP, or if done through a procedure regulated by the tax authority in the same calendar year the transaction takes place. So these two limitations, we did not think, and we positioned that they were not in line with the arm's length standard. Because again, from a practical point of view, if you give the authority the power to regulate how this is done, they could over-regulate, they could require some form of pre-approval, pre-authorization, pre-audit process, whatever, which is, by the way, common in Brazil in other situations where tax credits or tax deductions need to go through them. And on the other hand, if we're looking at a tax year, which is the full calendar year, for example, and the calendar year is not closed, we might not have full data, full comparables for the whole year. We don't have all the transactions for the whole year to be able to properly figure out what adjustment needs to be made. So normally, at a minimum, this would have to be done at the subsequent calendar year, or with the filing of the tax return, which is in the subsequent calendar year. So 6 months later, at least. So we've actually positioned, there was over 100 amendments on different topics, but this was one of the amendments that we really fought hard to get through. It didn't, where basically we were asking for the authority simply to audit, not to have a pre-authorization whatever process, and also for the timing not to be concurrent, not to be the same calendar year the transaction takes place, for it to be, let's say, if at most within the statute of limitations, but at least within 1 year of the closing. It did not happen. So right now, we can only do downwards adjustments either through MAP, or if it's within the same calendar year the transaction takes place, which is not good. We had one ugly, I'm sorry, go ahead.
Yeah, Romero, just on that, to spell this out, does that mean that year-end adjustments are not possible unless it goes upwards, or unless you manage to get them, you could say, through within the year?
Exactly.
Yeah, okay.
Exactly. So in practical terms, if you think about a downward adjustment, you're going to have to do it estimated effectively. You're going to have to figure it out based on third quarter data plus 1 or 2 months, and do the best you can with the other side to figure out what the right adjustment should be, and at least do the downward adjustment for that bit. If you need to correct and adjust it upwards afterwards, you can, and then you true it up. But at least you stamp within the same calendar year with the documentation you can produce what the downward adjustment might be. So this might be a practical hint already as to how life will not be so easy, even though we're aligning with the arm's length standard. With respect to the other adjustment I was going to say, which was coming out ugly, I'm going to mention it in reference to the controlled transactions and related party definition that Trolls highlighted. We basically replicated in the Brazilian rule also not only the primary adjustment, taxpayer initiated, tax authority initiated, and the corresponding or compensatory adjustment with this limitation that I've mentioned, but also a secondary adjustment. And the secondary adjustment would also apply with a fixed interest rate of 12% a year, which is obviously not arm's length given that it's fixed. You could think of it as a safe harbor, but perhaps it's not so safe given that the Brazilian rates fluctuate a lot, and this might be okay now, but it might be too high 6 months from now. So basically the way that we thought about it was the rule itself could be fixed if the interest rate was arm's length. But the fact that Brazil, in the methodology of putting together the rules, aside from the initial features that I've mentioned, which is almost ipsis liter is what's in the guidelines, what Brazil did was a patchwork of rules from different countries. So Brazil basically looked at the fact that not every OECD member country has secondary adjustments. A lot of them do. But it's a feature that seems protective of the local treasury. So Brazil wanted that. At the same time, when the definition of controlled transactions in related parties was being looked at, Brazil noticed that not every OECD member country, and actually a lot of them don't, covers only parties under common control. So it became a very common, very usual standard. 30 plus countries within the 70 plus that use the guidelines one way or the other use some form of substantial influence that could pose a threat to the arm's length standard. So Brazil liked that approach, which was again broader than parties under common control. But as it applied that together with the secondary adjustment, you could end up with a situation where parties that are not under common control could have a transaction adjusted subject to a secondary adjustment, that then the secondary adjustment perhaps could never be cured if the controlling interest would not align to unwind the transaction that had to be made, to unwind the deemed loan, for example. So you could end up, it's almost like a short circuit. You could have a collateral damage from having the secondary adjustment being put together with the broader definition of controlled transactions and related parties. And the way Brazil did it was even broader. That's the other part which is not great. Instead of just going, let's say, similar to the Italians or some of the other jurisdictions that use this broader standard, I'm not sure about Denmark, but instead of going just with the principle of substantial influence that could pose a threat to arm's length, and that is stated in the law, it also added another article that lists out transactions that are deemed to be the type of influence. The term uses influence, not substantial influence. It uses the word influence. So influence that could end up causing the parties to price not in accordance with the arm's length. But then the subsequent article defines influence by listing out situations where that influence, which is threatening, is presumed. And the list is non-exhaustive. So therefore, in interpreting the meaning of influence, the authority and the courts in Brazil, they can go beyond the principle, and they could actually define the principle in accordance with the list. And then in that list, you have, for example, common board members, even if the common board members do not represent control or substantial influence in each board. So common board members, relatives of board members. So we have a lot of situations like that where, depending on the market you're operating in, for instance, Germany, there's a lot of family-owned companies. The US, there's a lot of private equity with a lot of common minority interests. So depending on the market you're dealing with, you may end up with situations that are completely arm's length, but that Brazil will really deem the transaction to be subject to transfer pricing control. And depending on how the methods apply, the data comes through, etc., you could end up adjusting a market transaction to a fictitious price, basically, depending on how the rules will actually operate. So that plus the secondary adjustment was absolute gunpowder. So at least the secondary adjustment part was something we were able to suppress as the law went through Congress. It's not there anymore. The way we've positioned this was, at least if Brazil had a wider network of tax treaties to solve those situations where there was an adjustment that could not be cured, fine, but we don't. Brazil does not have a wide network of tax treaties, and many of the most relevant trading partners like the US and Germany don't have a treaty in force right now. So with that argument, we were able to at least defer the introduction of a secondary adjustment rule and move on. Unfortunately, we're still living with this broader definition of the related parties, which also include, by the way, not just those that are deemed to be related by influence, that's the one that worries the most, but also, not as a matter of definition of influence, but just as a prescription of the law, parties that are deemed to be favored tax jurisdictions or that benefit from privileged tax regimes. And those two terms are Brazilian terms. These are not terms coming from the Forum of Tax Administrations or the harmful tax practices language, none of that. So basically it's rate driven. And the rate that is being used now by Brazil is 17%. And the law does not specify if it's statutory or effective. So depending on the jurisdiction, if the jurisdiction has, for instance, RD&I incentives, innovation boxes, or whatever, any other types of holidays, even deemed non-harmful by the OECD subject to peer review, Brazil could be treating countries or entities that have a lower effective rate as favored jurisdictions or privileged tax regimes. Again, the law authorizes that. Let's see how the regulations come out. Perhaps they will stick to the statutory rate. perhaps they'll go with effective, but they are authorized to go either way. If we move, I'm sorry, Troels, go ahead. Otherwise, it's
no,
a
I
monotone.
think this is extremely interesting, and I just wanted to make sure that we touch upon a few items that I'm sure that the audience is very interested in. Is we have a lot of Danish multinationals that had run a principal system, basically wanting to and have been wanting to extract royalties from Brazil for years, but because of the old rules where a maximum of 5% was there, basically have not been able to. So what's the kind of, what should they be thinking about in terms of, now basically, can they implement a variable royalty, basically, or can they do triangular trade, which is normally when you have a principal system, or, there's also something about registration you still need to do, right, in order to get the money out of Brazil. I think the institute is IMPI. So maybe can you put a few words on what restrictions are still there?
This I actually classify as part of the good, and let's see how the regs come out. But the point is that the old Brazilian transfer pricing rules did not apply to royalties, period. And there's a lot of caveats there, because, for instance, copyrights are not deemed royalties for Brazil. They could hypothetically be covered by the old rules. There's some other situations that from an OECD mindset you would view as a royalty that would be covered by the old rules. Again, Brazil being Brazil. But as a general matter, royalties for the most part, especially industrial type, patent type royalties, they were outside the scope of the old rules, and they were subject to a very specific, very old 1950s reg, which had limitation thresholds. So up to 5% of the corresponding revenues generated from the use of the intangible was the deductibility cap. It would vary from different industry to different industry, from 1 to 5%. And for trademark royalties, for example, it was a flat 1% for all industries. Again, a formula from the 1950s. That's gone. So the deductibility problem that rule posed since forever is out. And it could be out effectively January 1st, 23, if our clients choose to elect into the system for this year. But for sure, from 24 onwards for everybody. So basically now, Troels, I mean, this is the good news. The good news is that all intangibles transactions will be covered in accordance, in terms of scope, with the arm's length principle. The definition of intangibles in the rule is very broad. The fact that we can consider either a direct charge or embedded intangibles consistent with other jurisdictions is also there. So a triangular situation could also be there. Given that we do have facts and circumstances and risks duly considered as part of the delineation of the transaction, would enable us to formulate a variable royalty much in the same way as everywhere else. But again, we have the new rules, we have the OECD transfer pricing rules, but we don't have the rest of the OECD tools, for instance, for certainty, for dispute resolution, etc. So, of course, the more complex, the more sophisticated the structure might be, the more you might need an APA or something along those lines, because again, it will be a learning curve for the tax authority. But a flat-out royalty, if it's not variable, not triangular, not embedded, which in the past you could not deduct, now you can. As to the remittability, for years, only a license that was registered, so intellectual property that was registered with the INPI, so with the Brazilian Patent Office, could give rise to convertible payments. So this is when we had very strict foreign exchange controls. Those controls started to be eased over many years, and even in the last few years, they are not relevant anymore as they were in the past. So you can get the money out even under the old system if the intangible exists and you have a reason to pay. You may have higher banking fees, but basically the system does not block payments anymore. This has been so for a few years. Now, under the new system, the same situation remains. So the registration with INPI makes the intangible recognized for non-tax purposes as an intangible. So it can be protected from piracy, from illegal use, etc. And it's a document that allows any bank operator to send money out using the official current spot exchange rate, which tends to be cheaper in terms of banking fees. So it's not that it's a block or a requirement, but it's a transaction cost problem. So you still have to go through the INPI registration, make sure the contract is such that it can be registered or audited by the central bank, so that you can use any bank to pay the royalties out without the higher transaction cost.
Super. Thanks a lot. Now we've started to receive a lot of questions, so I think I'll bundle some of them because they are evolving around, first of all, how would the Brazilian tax authorities probably, how would you estimate that they would look upon a company that with the application of the arm's length principle, potentially back to 23, we'll see a huge decrease in income allocated to Brazil? That's the first question. And then also, I think connected to that, there are a few questions on, is it possible to change the prices during the year, or does it have to be from the start of the year that you set the prices? And then finally, maybe how would the customs authorities look at this, if you have volatility in your TP prices during the year in order to reach a, let's say, targeted return for a Brazilian entity?
3 excellent questions. On the first point, again, Brazil is still Brazil. So we do see the authority as expecting this type of movement. So there's an expectation that in many sectors, for instance, where royalties could not be fully charged, pharmaceutical, high tech, there's a lot of situations where inbound multinationals doing business in Brazil ended up stuck with rules that would cause a double tax. Brazil knows that. That was part of the math that was done for this law to pass. So there is an expectation that the taxable income of a lot of inbound multinationals will decrease under the new rules. So from that sense, it's not going to be a surprise to the tax authority. They're not going to be overly aggressive simply because that took place. However, there's still the Brazilian tax authority, and they are on a learning curve. So they will definitely audit, scrutinize, but not scrutinize with a sense of suspicion. Scrutinize with a sense of learning whether or not the standard has been applied properly on the other side, and also in accordance with the regs that they're drafting right now. So this is the first point. Of course, the more complex the structure, the more sophisticated the structure, the more perhaps you're going to be stuck in a queue, a long line for an APA for a while, and you may be exposed, of course, to differences of interpretation as you would in other countries. But perhaps in the case of Denmark, at least we have the treaty to resort to and the MAP clause to at least try to use. And it's good news that the Brazilian tax authority is preparing to be more responsive and to be more engaged in MAP. So I think this is the first part of the answer. The second part is also a very good question. The law itself, the first article of the law, and I think it was done explicitly for this purpose, for the potential reflex on other taxes and duties, etc. It specifically states that those rules are for the determination of the corporate income taxes only. There's a reg that came out in September to regulate the early adoption, in February, to regulate the early adoption, which is for September. And we had raised this issue that even though the law had this provision there, the first article, that it was limiting its scope, that of course, if you produce delineation of transactions, comparability, etc., you could end up with either a new hypothesis of a question for a withholding tax or an excise tax or a customs duty or what have you. We raised that in our interactions with the authority, and in response to that, they came out with language in the regulation they published in February, again restating that the adjustments that are eventually done under the new transfer pricing law are not to be, and this is the tricky part, automatically considered or directly considered for the determination of any other taxes. So the way that I would think about customs is, again, the first method under the WTO, the transaction method, there's a presupposition there that there is an adherence to the arm's length standard. That's my reading, at least, of the first method. The fact that you could not price things at arm's length in Brazil before actually created a problem. So this is cause and consequence. So because we could not price in, otherwise we would have a double corporate income tax, we had to price it down. So if we had to price it down, now we have to price it up. That doesn't mean that the customs base was if you will, unlawfully used in Brazil before. We had to use that customs base, otherwise the transactions would not flow without a double tax. So basically that argument is there. There is a danger, of course, because theoretically, could you make the argument? You could. Could you make the argument that for customs purposes, you could have had the wrong answer? You could, but it's a very poor argument. I don't see that argument being successful in any way, shape, or form if taken by the authority to Brazilian courts.
Super. I've received two further questions that I think maybe you can answer quickly, actually. The first one is, does the Brazilian law include the low value-added services from the guidelines, or are they somehow, like India, for example, have explicitly said that that doesn't apply to us? But what's the Brazilian reaction? And then the second question, which I think is extremely important, is the documentation requirements. Because actually, I started out with talking about the Danish submittance requirements, but as we have talked together, I was actually surprised that there will be a similar scheme in Brazil going forward.
Right. So on the first point, and I'm sorry, I actually just skipped it. The second point on documentation, the first question was?
Yeah, the first point was the low value-added services.
Low value-added services, yeah. So after we go through those general provisions, Brazilian law does have specific articles and segments for all the specific provisions in the guidelines. There's one, for instance, dealing with intangibles. There's one dealing with cost sharing. There's one dealing with services. There's one dealing with capital. So the one dealing with services that is in the law is basically focused on coming up with a benefit test to limit headquarter charges, right? But other than that, it's basically stating arm's length pricing for services in the spirit of the guidelines. In earlier discussions we had with the authority, they contemplated including the low value adding safe harbor as part of the law. The point is that none of the safe harbors that we discussed, which could even be broader than low value adding services, we could come up with an amount B sort of thing for Brazil because of scarcity of data, for example. This is something we consistently proposed. But all of that will come in the regulations. There's an authorization, an express authorization in the law for simplification measures to be put together, for ease of administration, reduction of uncertainty, etc. And we expect that that will be the authorization rule for the low value adding services and for other safe harbors. As to documentation, Brazil has for many years been very advanced and even draconian in a way in terms of transparency from the taxpayer to the tax authority. Everything here is digital, systems-based. It has been so for many, many years. Transaction by transaction, general ledger being filed digitally. So it's full transparency from the viewpoint of the taxpayer to the tax authority, not necessarily the other way around. And the way that we've always done our historical transfer pricing work was contemporaneous. So we would have to do a new calculation every year. And this is signaled also in the new law. So even if we're operating under the arm's length principle, we have to revisit the study each year, even if only to confirm that the transaction delineated is the same, that the panel of comparables still holds, but we have to keep doing the study contemporaneously, yearly, and there will be a submission through digital form to be determined exactly how, which will be every year. And it's not just the local file. We're going to have to be filing here the local file, the master file, and the CBCR. And the expectation is that inbound multinationals will have to file their master files and their CBCRs here. So it's not an easy environment for documentation either, with a lot of different transaction-based penalties for incomplete or inaccurate information, irrespective of potential adjustments.
So that sounds like a little bit like Denmark, I would say. So something that is something we are used to, I would say, from a Danish perspective. I think on the we talked about services, we talked about royalties, but I think maybe, I guess, worth mentioning, of course, nothing of all this will change the high withholding taxes that you apply in Brazil on services and royalties, right? So could there be kind of an incentive from the or some discussions around characterization of transactions. So if we talk about the triangular trade, whether the embedded royalty is susceptible to having withholding tax, can you kind of foresee any of that coming on?
Yeah, I think the way that the law is written, the way that the standard has been set as a standard for corporate income taxes only, can help in exactly that type of planning situation you were describing. So if I have a value that I price according to the appropriate pricing of embedded intangibles, but the transaction is a transaction where the right amount is deducted for corporate income tax purposes, but for customs or withholding or what have you, there is a purchase and sale of inventory as opposed to a license fee, I should have the customs ramifications on that embedded intangible. That's the position that I would take now, looking at the law. Let's see how the regs come out, and vice versa. If I have a situation where the customs duties are prohibitive and I want to segregate and come up with a separate charge for the royalties that historically perhaps were trademark related and I couldn't get the right value out, and I was embedding it into finished goods, for instance, now I can carve it out and charge the royalty separately if that's less expensive than the customs burden. The point there, and to be very frank, it's very, very good that you asked this question, is that again, Brazil remains a closed economy for trade, and it remains a closed economy for services and intangibles. So we overtax everything. Digital services taxes, we have like 3 of them here for different names, different kinds for many years. So the point is that all of that would be tackled if Brazil continued with the same drive for accession to the OECD. So the roadmap for accession that came out as soon as Brazil confirmed adherence to TP, and still at the beginning of last year, was one that was contemplating in the first point what I was reading as compliance with Brazil complying with Working Party 1 and the Model Convention. So withholding should definitely end up going down, and there was other provisions on transaction taxes, consumption-based taxes, etc., all being more harmonized and so on and so forth, and fostering trade. So there's enough language there that the CFA has put in the roadmap for Brazil's accession to the OECD, where I was really hopeful that all of that in due time would be tackled. Under this new government, I'm not so sure anymore, because this new government has already made public statements that, of course, they're not discarding OECD accession, but if or when it happens, it will be in their own terms. So I see a lot of suspicion there with the OECD. I see Brazil favoring the UN and the South versus North type of narrative. So now I'm worried that we're not going to be doing anything with withholding taxes and duties, etc., in the foreseeable future.
Thank you very much. It has been an amazing, what you've been able to explain about the whole background and also the content of the new law. So thank you very much, Romero. Now we will rush to the last item we have on the agenda, which is basically showing our tool on our risk assessment tool. So please, Valdis, you have only 7 minutes, but I hope you can make it.
Thanks, Charles. I hope I can make it too. And thanks a lot for a very interesting discussion so far, Romero. Maybe just in continuation of the discussion around the transfer pricing risks and opportunities and how to manage that, or actually taking a step back a little bit. So before we get to manage the risks, first of all, we have to map them. So we have to know which countries where our operations are and where we have activities, which countries are the most risky from the transfer pricing perspective. There's a lot of changes going on in the regulatory landscape in many countries with, for example, alignment to the OECD guidelines, which we are seeing in Brazil right now, or introduction of new stricter compliance requirements, for example, mandatory submission of documentation, which we've recently seen in Denmark. There's a lot of changes in many countries you have to keep up with. And we have come up with an approach that helps sort of staying up to speed with various changes that happen in many countries where we have activities. And I will just briefly show you a tool which we have developed for that purpose to sort of, in a quantitative way, assess where the biggest transfer pricing risks lie from the compliance perspective, as well as from controversy and APA strategy setting perspective. So the tool has basically two essential aspects. One is the risk from the country regulatory perspective, which we see on the screen right now. And another side is the evaluation of how significant the operations of the group in each of the countries are. So if we take a look at the country risk, we have determined certain parameters that we think typically define the riskiness of a country from a regulatory standpoint. For example, filing requirements of the transfer pricing documentation, if it has to be submitted mandatorily, contemporaneous preparation of transfer pricing documentation, penalties for not having transfer pricing documentation, many yes or no questions that we have answers to in our internal database. We are gathering here to evaluate a comprehensive outlook for each of the countries where the multinational groups operations are. There are certain other parameters that we build in that take care of the controversy side of things. For example, MEP closing ratio based on OECD statistics of how efficient a specific country's competent authority is in closing mutual agreement procedures. So all of these parameters in combination give us a combined view and a combined risk score for a specific country. And we can take a look at Brazil as an example. So from each of the parameters that we have here, Brazil obtained a score of, I think it's around 70, which in isolation does not mean a lot, but it helps placing Brazil among all of the other countries where the multinational group operates, and in that way prioritizing that country over the others. This view is based on the current regulations existing in Brazil, and we may be expecting changes with the new alignment with the OECD guidelines in Brazil that we can see easily by just scrolling the filter here. And we can see that when Brazil becomes aligned with OECD guidelines based on our tool, it would become less risky because in a way we're sort of speaking the same language, using the same OECD terms and so on. However, as we heard from Romero before, there may be certain other counterfactual trends, such as increase in APAs for royalties, for example, or limitation towards year-end adjustments that may move this, push this to a more risky side of the spectrum. So now, having looked at the regulatory perspective of the country, we can move into how significant the operations are of a specific entity of the group in a specific country. So from that perspective, we're looking at different materiality thresholds, such as revenue, number of employees, intercompany transaction volumes, and so on. And again, we list the most prioritized or most risky entities having a score of maximum 100 and the other ones being adjusted accordingly. Now, those two perspectives in combination give us a view that maps each of the countries where the group has operations on this matrix, where we have country risk on a horizontal axis and entity risk on vertical axis, which in combination gives us a risk score on this matrix. On the top right side of it, we would see the most risky or the most prioritized countries where we would likely place most of our efforts with respect to transfer pricing. The size of the bubble represents the revenue in that specific country. So even though in this case Greece and Argentina may be coming out for this specific hypothetical scenario as the most risky markets, they are very small in terms of operations, and we may need to apply additional level of thinking and maybe not put too much attention to it and rather focus to the bigger countries such as Peru, Denmark, or other ones that are appearing on this map. So overall, and just to sum up how this tool can help with mapping the risks. So first of all, it helps prioritizing key jurisdictions and most risky jurisdictions. It helps focusing limited resources, both from human and financial resource perspective, on the countries where our transfer pricing work can make the biggest impact. And it helps evaluating the risks from tax controversy and APA strategy setting perspective. I think that was it, and I'll give the word to you, Charles.
Thanks a lot, Evelis, and that was truly amazing that you could cover that in 7 minutes. So I want to thank you, all of you. I just had one question from one of our attendees. What language should the documents, so the documentation, be submitted in? And Romero has told me that actually at this stage, foreign language is okay, or at least allowed. But let's see what is in the regs about it, because of course, probably not possible to submit in Danish, I would assume, but let's see whether English is possible in the future. But we can get back on that one once we have
English,
the regs.
I'm quite certain that English will be because this again, the authorization is express, and the authority mentioned it. But in one of the panels, I asked them, what about a Korean client of mine? Can they send it with the Korean language? And they were scratching their head. So probably there'll be some limitations in terms of how many languages they will accept.
Thanks a lot for that clarification. And thank you all for attending this seminar. Please get back to us if you have any further questions. But as we started out saying, there is a window now from 1st of September to 30th of September, we think, that's the current status at least, where you can still decide to apply the arm's length principle for 23. So it's worth thinking about whether that would be optimal for you to use to have the 23 year already covered by the arm's length principle, or whether you should wait until 1st of January 24 when it becomes mandatory. So on that note, I want to thank everybody for participating and have a great day. Bye.
Bye.